The most important problem that Canadians are facing is that money is flowing in and most of it's leaving without their control. The problem is that money is leaving you. So we want to reverse the flow of that cash that's already being paid to someone else. The banking industry is lending money with security rather than investing with risk. Well, why don't you just take over that function and lend yourself the money and make those payments back to your own system rather than investing with risk? And if you want to go out and take risk, great. You can access capital from your policy system and your cash value is going to go up. If the stock market goes down, cash value goes up. If the stock market goes up, cash value goes up. So it goes up no matter what. Remember, your wealth, your money, your capital must reside somewhere. Whether you're saving money or you're just storing capital waiting for your next opportunity, it's got to be stored somewhere. Now, we're going to do a bit of a thought experiment here, and we're going to get some participation from you here in a moment. So we're going to be able to create the perfect investment. Now, perfect. Now, remember, the only limitations in your mind are the ones that you put on yourself. There are no drawbacks. That's the only condition. If you're going to create an asset from scratch, there has to be no drawbacks in this thought experiment, okay? So what I'm going to do is I'm going to get your brains churning a little bit, and I'm going to give you some of the top responses that we've gotten from people. So we're creating the perfect asset from scratch. So we've heard people say, hey, very first thing out of the gate, we want a high rate of return. We want a consistent rate of return. So high rates of return and a consistent rate of return, and want it to be conservative or safe. So let's see what the list of attributes, the most popular answers that we've gotten from the past look like. Liquidity, that was the very next one that came. Guaranteed, tax benefits, no market volatility, yields besides capital gains, yields income besides capital gains. Creditor protection, that's a great one. Inflation protection, I heard that one in there. Control, transferable, so that sounds like somebody said generational wealth, I think. Easy to manage, no hidden fees or penalties. Reputable, so well-known. And private. Now, this is a more important question. For your own various assets, simply identify which of the features from the list above that your assets do well on, and which of the features do your assets fail to satisfy. Now, think about that. Let that sink in. We have a surprise for you. The list of attributes that was shared most accurately describes a participating, dividend-paying whole life policy. Now, just to make sure, now, why am I describing a dividend-paying, participating whole life policy? Well, the reason for that is because we're talking about something called the process of becoming your own banker. And then we have to have a tool to implement the process of becoming your own banker. And the best tool that we've found for that job is a dividend-paying, participating whole life policy, ideally with a mutual insurance company. So it's important to recognize that the process of becoming your own banker is not about a product. Becoming your own banker actually has nothing to do with life insurance whatsoever. However, the best tool, you could use any tool you want. The best tool for the job is a dividend-paying, participating whole life policy. I mean, you could go out in your yard, not in Alberta because it's still snowing here, but if it's spring where you're at and you need to cut your grass, you could use scissors. You can get on your hands and knees and cut your grass with scissors, but it's just not a great tool for the job. You'd probably want like a push mower or a ride-on mower, something that has some rocket fuel so you can get the job done much quicker. So you could use a shoebox to implement the process of becoming your own banker. It's just not a very good warehouse. It's not a very good tool for the job. The best tool that we've been able to find is a dividend-paying, participating whole life policy. And I'm going to walk you through exactly why we use this tool for implementing the process of becoming your own banker. The first attribute is participating. You become a co-owner. You become a part owner in the life insurance company, and you participate in the profits generated from every line of business. So when we're dealing with a mutual insurance company, they're selling term insurance, universal life insurance, whole life insurance, critical illness insurance. You know, they have segregated funds, all these different types of products, income streams that are coming in and creating profit for that insurance company. And we get to benefit from all of those income streams, all of those different products. Dividend paying. Each year, the life insurance company declares a dividend. It is contractually guaranteed to be paid to the participating policyholders. I say that again, contractually guaranteed to be paid to the participating policyholders, and it can never be taken back and never repossessed. It can never lose value. So it becomes vested and guaranteed by the insurance company. Whole life. Well, we have coverage. We have life insurance that will last you your whole life. The contract goes until age 100. The total cash value of the death benefit. So we have a death benefit and we have cash value that's rising. The total cash value of the policy must rise each and every day such that it matches the total death benefit by the time the life insured reaches age 100. It can never lose value. So every day that you age, there's more cash value in the policy than there was the day before. As I mentioned earlier about my own system, our net worth increases every single day just because God blessed me with oxygen today. I think that's pretty good. We don't have many guarantees anymore in life. As you all know, pensions are going by the wayside. There's doubts about the future. However, dividend paying, participating whole life insurance can help create peace of mind and unmatched financial security. And here is how. Cash value begins to accumulate immediately. So right from day one, and it is contractually guaranteed to grow daily, and cash value cannot go down. Easy access. You have easy access to a growing pool of financial value that you can use to take advantage of opportunities when they track you down. So we're warehousing our capital, and opportunities will track you down. You're not penalized for accessing the money early like you are with an RSP or other financial products. There are several tax advantages, both personally and corporately. It provides a growing death benefit, which will be paid to the named beneficiaries income tax-free. So I repeat, it provides a growing tax-free death benefit. So imagine, just to create a visual here, imagine you have this death benefit that starts here, and we have this cash value that starts lower because it has to match by age 100. So the cash value begins to rise every single day. Now, as we capitalize that policy, the death benefit is going to expand. So the death benefit's expanding over time. So we're increasing our legacy down the road. We're thinking long range. That's great, but we have forced efficiency engineered into the policy system. It's built right in because the life insurance company is looking at actuarial calculations to say, okay, Vern's 38 years young today. He's got a $1.2 million permanent death benefit. We need to put X amount of dollars per day, 27 bucks a day into his policy every single day right now. Well, what happens when I capitalize that policy again and I receive my first year dividend? My death benefit's going to significantly expand. Well, now they're going to look and go, uh-oh, Vern's 39 years old now, and his death benefit's gone up to 1.6 million. Well, now we can't put 27 bucks a day into the policy anymore. We have to put whatever that number is more. We have to put 35 bucks, whatever that number is. I don't care. But the point is that daily cash accumulation is going to expand and accelerate over time. So the policy is going to become more and more efficient with more time that goes by, the more we capitalize, so we can achieve objectives. So what I'm going to show you here is I want you to realize, as I mentioned earlier, you are your own best advantage. Think about this for a moment. You're already some other bank's best customer. You're already a great customer. If you're paying your mortgage and you're paying your light bill and you're doing all these things, you're reliable to make your car payments and your line of credit payments or whatever. You're already somebody else's good customer. The banking industry is lending money with security rather than investing with risk. Well, why don't you just take over that function and lend yourself the money and make those payments back to your own system rather than investing with risk? And if you want to go out and take risk, great. You can access capital from your policy system and your cash value is going to go up. If the stock market goes down, cash value goes up. If the stock market goes up, cash value goes up. Real estate market goes down, cash value goes up. Real estate market goes up, cash value goes up. So it goes up no matter what. Now, I'm going to give you a visual to think about here. Now, you can see that this green line is rising, right? It's growing and compounding. Now, that represents the cash value that's accumulating in the policy to chase the death benefit. Okay, this is the death benefit. And imagine this is age 100 up here. All right. And this represents time. So we had a starting death benefit, and I'm just making up a number here. Let's say our starting death benefit is $100,000. Now, this death benefit is going to rise over time. Time's going by anyway. So this death benefit is going to grow and expand over time as we're capitalizing the policy and as the policy is receiving dividends, because the policy dividends and some of your capital that's going in are going to purchase blocks of what's called paid up death benefit, paid up additions. Those paid up additions are going to be added to your original starting death benefit. So the death benefit's expanding, and now the cash value growth has to accelerate to stay on track, because the window of time that the insurance company has to make sure the cash value and death benefit match is shrinking. So the time is shrinking and the promise is expanding. Now, this red line, I don't want you to get caught up too much on this zero and this red line going below. We can't borrow more than what's 90%, okay? My 90% of the total cash value is what we can access anytime we ask for it, because we own the bank. We're the banker and the bank owner. The life insurance company merely administers the contract. We set all the terms. What we're illustrating here, though, is this green line, as I said, is representing your cash value growing every single day. Time's just going by. Now you're capitalizing this policy instead of someone else's bank, or instead of paying down your mortgage, or instead of accelerating your car payments. You're freeing up as much of your existing cash flow or as much as your existing savings and just changing the address of where that money is deposited or flowing to. And we're depositing it in the form of premium into our policy system. And as we do that, our cash value is rising. Now, eventually, as you're going through life, life is going to happen. If you're like me, you have aging parents whose health is declining, unfortunately. Maybe there's a care home, or maybe something that you have to do for your parents. Maybe their roof goes and you want to help fix your parents' roof. Or maybe your mortgage comes up for renewal and you want to accelerate your mortgage pay down, but instead of increasing your monthly payments, you're just going to wait till the mortgage renewal comes and you're going to access a large policy loan and chunk it directly onto the principal. That way we shrink the amortization, and we can also have an impact on the payment, the money that's leaving you. Because remember, the most important problem that Canadians are facing is that money is flowing in and most of it's leaving without their control. The problem is that money is leaving you. So we want to reverse the flow of that cash that's already being paid to someone else. And that's exactly what this process will allow us to do. You have a choice. You can go and access money from someone else's bank and pay an interest to them, and they get all the capital and they keep all the control. Or you can access your own cash that's been saved up and you can put it into the investment, but now the capital is gone because it was used to purchase the investment. Your cash is no longer growing, it's gone. Or we can turn around and look at this ever increasing pool of financial value, and we can access what's called this policy loan. Okay, now we get this policy loan and we borrow it out of the policy to take advantage of said opportunity. Now let's assume that that opportunity is creating maybe some cash flow. Well, if cash flow is coming in, doesn't that cash flow need a home? Can it go right back into this pool to replace what you borrowed? Or maybe you take out this policy loan and you eliminate a debt. If you eliminate a debt, didn't we free up a payment? We sure did. Can't we take that existing payment that was already flowing away from you, those dollars? Can't we take those dollars and flow them right back to your system and replenish the policy loan that you used? Because we're being responsible bankers. We're not stealing the peas. What's happening to the policy loan balance? The policy loan balance is coming down. Do you see that? We're making those payments because we're responsible. Oh, and by the way, who's in control of the repayment schedule? If you wanted to increase the payment going back to the policy loan, completely up to you. If you want to decrease that payment, that's completely up to you. But you can notice, if I just take my imaginary loan balance here, look at the time is still going by, the ever increasing pool of financial value. You always have access to this sandwich in the middle between where the cash value is at today and what your loan balance is. So we have access to an ever increasing pool of financial value. So this is how we can reverse the flow and take the banking function from working against you and have it work for you, because you are your best advantage. It's all about what you can control.